I was staring at my terminal this morning, January 7th, 2026, watching something that shouldn't exist in a free market. Silver hit $82.50 per ounce and stopped. Not pulled back, not corrected, stopped. Like it hit an invisible ceiling made of pure mathematics and institutional terror. The atmosphere in the trading world right now is heavy, unsettling even. Because while the mainstream financial media is spinning this as healthy profit-taking and calling it a long overdue technical correction, after silver's parabolic run, something else is happening that they're not telling you about. I'm a private commodities analyst. I've been stacking physical silver and trading these markets for 12 years, and I built this channel because I was tired of waiting half a day for CNBC to report what I could see happening in real time on my Bloomberg terminal. And frankly, I was sick of watching all these AI-generated channels pump out fake hype about silver with zero actual data behind it. Here's what your screen is showing you right now. Red. Lots of red. Silver is getting absolutely mauled in New York, down to $78.60. The technical traders are calling it a bloodbath. But here's what your screen isn't showing you. While paper silver is being demolished on the COMEX, physical metal is vanishing in the East. And I mean vanishing. The screen is lying to you. It's early afternoon on the East Coast right now. The data I'm looking at is maybe 2-3 hours old, fresh enough to still be warm. And the math behind what just happened, it's already broken, because they forgot to check the vaults in the East. And that's where this entire narrative falls apart. Let me be crystal clear about what I'm claiming here, because this isn't speculation. This is what the data is screaming at anyone who knows where to look. Bullion banks are intentionally smashing the paper futures price down to $78.60 to protect underwater short positions. Why? Because they physically cannot fulfill the delivery demand at the current COMEX price. They don't have the metal, or they have it, but they can't let it go without triggering a cascade that breaks the entire pricing mechanism. And here's the kicker that should make your jaw drop. While Western paper silver is bleeding out, Indian retailers are selling physical silver at nearly double the COMEX price. Not 10% more, not 20%, double. In this breakdown, I'm going to walk you through exactly how the delivery stop mechanism works, the thing they never taught you in any finance class. I'm going to run the stress test math on COMEX inventory that has my risk alerts flashing red. And I'm going to share my personal battle plan for the next 48 hours, what I'm watching, what my triggers are, and what I'm absolutely not going to do, even if the volatility makes my palms sweat. But first, you need to see what JP Morgan did on Tuesday. Because when I saw it, I actually laughed out loud. It's a move of pure, unfiltered desperation. All right, let me give you the snapshot of where we are right now. This is the on-the-ground reality as of midday Eastern Time. Silver spot price, $78.60 per ounce, down 4.71%. That's a $3.89 drop in a single session. Gold is sitting at $4,460.53. Also red, but holding up better than its little brother. Platinum and palladium, they're bleeding too, down 5.68% and 4.35% respectively. The whole precious metals complex is under pressure, but let's talk about that brick wall at 82.50. If you pulled up a chart this morning, you would have seen something deeply unnatural. Silver climbed, hit $82.50 and just stopped. Not a wick, not a spike and rejection, a perfect flat line, like someone drew it with a ruler across the top of the candle. Markets don't do that. Markets fluctuate. They breathe. They test levels, pull back, retest. This was algorithmic. This was an institutional order sitting there like a wall of concrete, absorbing every single buy order that came through. And then came the panic dump, vertical, straight down. The kind of price action that makes your stomach drop, even if you're not holding a position. From 82.50 to 78.60 in what felt like minutes. Now here's where it gets interesting. While that was happening on your screen, I pulled up my feed from Indian physical retailers. Joyalukas, Sri Jagdamba Pearls. These are legitimate, established bullion dealers in India. You want to know what they're selling physical silver bars for right now? $120.99 per ounce on the low end, $137.85 on the high end. Let me repeat that, because I want it to sink in. The COMEX paper price is $78.60. The physical price in India is up to $137.85. Do the math with me. 137.85 minus 78.60 divided by 78.60. That's a 75% premium over the COMEX price. 75%. Now, I can already hear the objections forming in your head. That's just Indian import duties. That's GST. That's local taxes. We'll get to that. Because those arguments don't hold water when you actually run the numbers. But we'll address the skeptics properly in a few minutes. Right now, what you need to understand is this. The paper market has decoupled from physical reality. And it's all because of a mechanism they never taught you in school. A mechanism that's draining the COMEX vaults faster than most people realize. Let's pull this apart. Because if you don't understand how COMEX delivery actually works, none of the rest of this is going to make sense. There are two key terms you need to know: issuing and stopping. And I'm going to explain them so clearly that you'll never forget the difference. Issuing means you are the seller. You are the entity handing over the physical metal to settle a futures contract. You're saying, here, take this silver out of my vault. Contract fulfilled. Stopping means you are the buyer. You are demanding the metal. You are stopping that contract from being rolled over into the next month for cash. You're saying, no, I don't want your cash. I want the actual silver right now. Think of it like an overbooked flight. An airline sells 100 tickets for a plane that only has 10 actual seats. Usually that's fine, because most people are willing to take the cash voucher and catch the next flight. The airline makes money. People get compensated. Everyone's happy. A delivery squeeze is when all 100 people show up at the gate at the exact same time and refuse the cash voucher. They all want their seat. Right now, the airline panics because they don't have 90 extra seats to materialize out of thin air. That's what's happening on the COMEX right now. Except instead of airplane seats, it's physical silver bars. And instead of passengers, it's institutions, foreign governments, and high net worth individuals who are done playing the paper game. Now, here's why this matters today. On Tuesday, just a couple days ago, JP Morgan issued 63 out of 150 delivery notices. That means they were the seller. They were pulling silver out of their vaults to settle contracts. At the same time, Macquarie stopped 81 contracts. They were the buyer. They were demanding delivery. Banks are depleting their physical vaults to settle paper contracts just to keep the price from exploding past $100. Because if they can't deliver, if they have to declare force majeure or cash settle only, the entire pricing mechanism collapses. Confidence evaporates. And silver doesn't stop at 100. It goes parabolic. So the question you should be asking right now is, how many seats are actually left on this plane? How much silver is actually sitting in the COMEX registered vaults available for delivery? Because I've been running the numbers, and they're terrifying. Let me walk you through the math. And I want you to follow along carefully, because this is the part where most people's eyes glaze over, but this is where the truth lives. As of January 6th, the month-to-date delivery notices hit 4,697 contracts. Now, each contract represents 5,000 ounces of silver, so that's 4,697 times 5,000, 23,485,000 ounces in just the first 3 trading days of January. And January isn't even a primary delivery month. February, March, May, July, September, and December, those are the big ones. January is supposed to be quiet. So let's run a stress test. Let's be conservative and assume this pace doesn't accelerate. Let's assume it stays exactly where it is right now, even though historically, delivery demand tends to increase as the month progresses. If this pace continues, how quickly does the COMEX registered inventory drain? As of the last vault report, I pulled COMEX registered silver. That's the silver that's actually available for delivery, not the larger eligible category that's just sitting there but not allocated. Registered silver is hovering somewhere in the mid 30 million ounce range. If we're pulling 23 million ounces in the first week, we could theoretically drain below the critical 30 million ounce threshold before we even get to March. And once you get below 30 million, that's when the real panic starts. Because that's when the leverage ratio, the amount of paper contracts versus actual physical metal, becomes impossible to ignore. Now let's talk about that premium again. Because this is where the disconnect becomes mathematically undeniable. The formula is simple. Premium equals physical price minus paper price divided by paper price. Using the Indian data, 137.85 minus 78.60 divided by 78.60. That gives us approximately 75%. Let me give you a checkpoint recap because we've covered a lot of ground and I want to make sure you're still with me. Here is what we know so far. The price hit a mathematical wall at $82.50. It wasn't a natural resistance level, it was an institutional ceiling. The East is paying a 75% premium to get physical metal right now. And the COMEX vaults are draining at a pace that is usually reserved for global financial crises or geopolitical collapse. Now stop for a second. Look at the volume on that dump from 82.50 down to 78.60. Look at the size of those red candles. That isn't retail selling. Retail doesn't move markets like that. That's institutional liquidation. That's coordinated. That's someone, or more likely a group of someones, deciding that the risk of silver breaking through $83 was too high and they needed to kill the momentum immediately. So here's the question that should be keeping you up at night. If the physical market is this tight, if the premiums are this insane, if the vaults are draining this fast, Why is anyone still selling paper silver at $78? Now, I know what the skeptics are going to say. I can hear the objections already. So let's steelman the counter arguments and address them head on, because if I don't do this, you're going to have doubts. And I want you to have clarity. Skeptic argument. Number one, this is just a technical correction. Silver was overbought on every indicator. The RSI was in the 90s. It needed to cool off. And those Indian prices are high because of local import duties, GST, and taxes. You're comparing apples to oranges. All right, fair point on the surface. Let's dig into it. Yes, silver was overbought. Yes, a pullback was overdue from a technical standpoint. I'm not disputing that, but that doesn't explain the brick wall at 82.50. Overbought assets pull back. They don't hit a flat line and then dump vertically. Those are two different types of price action. As for the Indian premiums, let's do the math on import duties. India's import duty on silver is 10%. GST is 3%, so you're looking at roughly 13% in total taxes and fees. 13% on a $78 base price is about $10. So the all-in cost for importing silver into India should be around $88, maybe $90 if you factor in logistics and dealer margins. We're seeing prices of $120 to $137. That's a $30 to $47 gap that cannot be explained by taxes. Something else is driving that premium, and that something is physical scarcity. Here's another myth I want to bust while we're at it. High volume means high liquidity. The market is functioning fine. Wrong. High volume during a vertical dump like this is often what I call liquidity harvesting. It's when the big players trigger retail stop losses, those automatic sell orders that retail traders set to protect themselves, to fill their own buy orders at artificially low prices. You see a volume spike and think, oh, lots of trading activity, the market must be healthy. What's actually happening is the big fish are eating the little fish. They're forcing you to sell so they can cover their positions cheaper. And here's the evidence that this wasn't organic price discovery. That flat line at 82.50. Markets don't flatline naturally. They fluctuate, they test, they probe. That was an iceberg order, a massive institutional sell order designed to absorb all buying pressure and kill upward momentum. If you've ever wondered what it looks like when the big banks are genuinely scared, that's it. That's the signature. Because if they weren't terrified of what happens at $83, they wouldn't have needed to build that wall. So what happens next? Because that's the question everyone's asking. Okay, I see the disconnect. I understand the delivery squeeze, but what do I actually do with this information? Let me walk you through what I'm watching over the next few days and weeks. First, watch for the CME to hike margin requirements. This is their go-to move when volatility spikes. They'll frame it as protecting market integrity or ensuring orderly trading. What it actually does is force smaller traders, retail guys like you and me, out of the market because we can't afford to put up the extra collateral. Meanwhile, the big shorts get breathing room to cover their positions without the price running away from them. Second, I've got my dashboard focused on three key metrics. COMEX, registered inventory. If that number drops below 30 million ounces, the panic begins. We're close. We're very close. The 82.50 retest. If silver climbs back up and tests that level again, and we fail to break through, that tells me the brick wall is still active. The banks are still in control. But if we smash through 82.50 and hold above it for a daily close, that's a different story. That means they've lost containment, media coverage, or more specifically, the lack of it. I expect the news cycles to focus heavily on gold, or the dollar index, or literally anything else to distract from the silver delivery numbers. When mainstream financial media goes quiet on a specific topic, that's usually when the most interesting things are happening. Now, let me talk about how I'm personally navigating this minefield, because I don't want to just throw data at you and leave you hanging. I want to show you my actual process, my triggers, my plan. This is not financial advice. This is me sharing exactly what I'm watching in my own portfolio and what I'm prepared to do based on specific conditions. Trigger number one. If silver closes a weekly candle above $83, I'm personally looking to increase my physical exposure significantly. To me, that signals that the banks have lost control, that the paper price is breaking free from the suppression mechanism. And in that scenario, I want to be holding as much physical metal as I can reasonably store. Notice I said physical, not SLV, not futures contracts, not mining stocks, physical bars and coins in my possession. Because if this turns into a genuine delivery crisis, paper proxies are not going to protect you. Trigger number two. If the COMEX issues a force majeure notice or announces that contracts will be cash settled only instead of physically delivered, I'm treating that as a system failure signal. That's the moment the paper market officially breaks from reality. In that scenario, I'm exiting all paper-based metal proxies immediately, ETFs, futures, all of it, because those are claims on metal that may not actually exist. Now, here's what I'm not going to do, and this is just as important as the actions I will take. If the CME hikes margins and the price drifts sideways between $75 and $80 for the next few weeks, I'm doing nothing. I'm sitting on my hands. I'm not letting them shake me out of my core position. This is the part where a lot of retail traders lose. They see the price drop, they see the red candles, they panic, and they sell at exactly the wrong time, right into the hands of the institutions who are covering their shorts. I've been through enough of these cycles to know what a shakeout looks like, and this has all the hallmarks: the vertical dump, the media narrative, the manufactured fear. So I'm holding my physical, I'm watching my triggers, and I'm staying patient. Because here's what I know: the clock is ticking for the shorts. Every day that passes, more ounces leave the registered vaults. Every delivery notice that gets filled is one less bar available for the next guy. The math doesn't lie, the inventory doesn't replenish overnight, and I know which side of this trade I want to be on. Let me bring this home with a recap, a forecast, and a call to action. Silver is being artificially pinned at $78.60 through coordinated paper selling on the COMEX, while physical metal is being stripped out of the market at $137 in India. 23 million ounces have already been delivered in the first week of January, a month that's supposed to be quiet. The bullion banks are underwater on their short positions. They cannot allow silver to break decisively above $83 without triggering a cascade that forces them to cover at catastrophic losses. So they're doing what they always do: smashing the paper price to buy time, hoping that physical demand will ease before the vaults run dry. But the physical demand isn't easing, it's accelerating, and the vaults are draining faster than they can be refilled. Here's my rallying cry, and I want you to remember this: the paper price is a suggestion. The physical metal is the reality. Don't let a chart on your screen tell you what your eyes can see in the vault reports and the premium data. If you want to understand how this gamma squeeze actually started, why the banks were caught off guard in the first place, and why December's inventory levels set the stage for what we're watching unfold right now, you need to go back and watch my full breakdown of the December delivery cycle. That's where the fuse was lit. This is just the explosion. I'll drop that link right here. Watch it. Understand the foundation. Because this story is only getting started. And if this breakdown helped you see through the narrative and understand what's actually happening behind the curtain, do me a favor. Share this with someone who needs to see it. The mainstream media isn't going to cover this until it's too late. We're the first movers. We're the ones who see it happening in real time. I'm going to keep watching the data. I'm going to keep pulling the vault reports. And I'm going to keep translating this into plain English for you because someone needs to. Stay sharp, stay patient, and I'll see you in the next one.